Good morning, capital allocators, spreadsheet savants, and risk-adjusted thrill seekers. Before we drown ourselves in ratios, I want to frame today's thesis with a single provocation. Why wrestle for basis point margin when you can mint Bitcoin per share? My name is Adam Livingston, and I'm your number one source for Bitcoin and Bitcoin Treasury Company analysis. Today, we will be diving into BTC yields, one of the most fascinating subjects you must know about to be on the cutting edge of the most rapid and important transformation in the history of finance. The context: we live in the age of diminishing operating leverage. In 1965, the S&P Industrials captured 8 cents of profit per gross sales dollar. In 2025, after 50 years of ERP systems, global supply chains, and consultants who bill at Manhattan rent prices, the average blue chip still captures 8 cents. Operating margins hit a physics limit set by wages, taxes, and competitive arbitrage. The juice is gone, yet Wall Street still worships EBIT like it cures baldness. Enter BTC yield, scarcity compounding in a bottle. BTC yield tracks how many extra satoshis each fully diluted share inherited in a period of time. It is natively marginless, borderless, and open 24/7. Think of it as thermodynamic buyback. Instead of shrinking the denominator with cash, you swell the numerator with an asset that cannot be printed. Strategy added 74% BTC per share last year. Apple, the GOAT of operating execution, posted a stellar but mortal 34% return on invested capital. One firm sold 0 widgets, the other shipped 225 million iPhones. My iPhone is gorgeous, yet it does not double scarcity on the balance sheet every 8 months. You should care because BTC yield is the reflexivity dividend. Each incremental Satoshi pushes BTC per share north. The market stories itself into a higher premium. That premium funds the next BTC purchase, and the loop goes again. In plain English, narrative pays for itself. When done correctly, the shareholder's cost of capital is weaponized into harder money. Here's the roadmap. We're going to go over the formula and mechanics. We will dissect BTC yield and its sharper cousin, TBY, torque-adjusted Bitcoin yield. We're going to go over case studies, strategy, meta-planets, and a cautionary tale or two. We're going to talk about the risk panel. Yes, volatility is a feature, not a footnote. And a playbook, a CFO-ready template to deploy this engine responsibly. So buckle up, extinguish your love affair with incremental operating margins, and let's learn how to compound scarcity faster than meme coins at a Vegas bachelor party, only with audited financials and a treasury wallet. We're going to set the scene. We're going to talk about margin arithmetic versus scarcity arithmetic. Traditional companies are locked in a Sisyphean contest. Squeeze 1 more basis point of gross margin before labor costs, input prices, or a hungover competitor erases it. Decades of Six Sigma, globalized supply chains, and cloud ERP shaved pennies, yet the median S&P operating margin still hovers in the mid-teens. The treadmill accelerates, the finish line does not. Capital markets do not award style points for busy factories. They reward growth per share. If dilution outruns profit growth, even flawless execution produces a flat share ownership pile. Ask any PM, would you rather own 10% more revenue or 10% more of a fixed supply asset per share? The vote is nearly unanimous for scarcity. There are structural headwinds on the operating side. There's input inflation, energy, wages, and reflexively, margins compress. There's CapEx gravity. Every expansion burns free cash flow, which postpones buybacks or dividends. And there's competitive arbitrage. Any outlier margin invites copycats with cheaper labor or a more reckless VC backer. Imagine a different engine entirely. Suppose you could expand intrinsic value without adding factories, headcount, or working capital. Suppose the numerator of value scales with a hard-capped monetary asset while the denominator, fully diluted shares, is managed like a precision instrument. That is the nucleus of BTC yield, and in a few moments we will quantify why it can leave even elite operating models in the dust. Keep that framing in mind. Margin is a marathon on a treadmill. BTC yield is an escalator tied directly to programmable scarcity. Next, let's formalize this metric so we can see exactly how the escalator moves. So here we go, folks, introducing BTC yield. BTC yield is the percent change period to period of the ratio between Bitcoin holdings and fully diluted shares outstanding. The numerator of the big fraction, next period's Satoshi stack per fully diluted share. Denominator is today's Satoshi stack per fully diluted share. The subtraction and times 100% simply translate the growth ratio into the universal language of, is this number green? Yes, we're literally grading management on their ability to make each share a little heavier in digital gold. Why fully diluted isn't optional, you ask? Options, restricted stock units, convertibles, warrants, if they can morph into common shares, they're already in the denominator. This is the anti-EPS game, no creative share count gymnastics. If your cap table looks like a bowl of alphabet soup, the metric will expose it. There is positive versus negative terrain, the binary truth table. If Bitcoin per yield is greater than 0%, what happened is that your BTC stack grew faster than dilution. The translation for shareholders is congrats, each share now owns more hard money. If BTC yield is less than 0%, that means your dilution outran your stacking. The translation for shareholders is management just pickpocketed your Satoshis. No footnotes, no pro forma add-backs, just raw scarcity arithmetic. We can run this every quarter, every year, or across a multi-year capital program. Because Bitcoin's supply is hard capped, compounding positive yields becomes exponential. The curve bends faster once the flywheel turns. On the flip side, one reckless issuance round can nuke a year of disciplined stacking. The metric keeps the sword hanging over the C-suite. Picture a firm with 10 Bitcoin and 10 million fully diluted shares, 1 Satoshi per share. It raises equity, buys another 5 BTC, but share count rises to 12 million. The new ratio would be 15 BTC divided by 12 million, which equals 1.25 Satoshis per share. That's a plus 25% BTC yield. Now imagine the same raise without the BTC purchase, dilution only. The ratio drops to 0.83 sats minus 17% yield. Same bank syndicate, wildly different shareholder outcome. Let's cut straight to the 4-lane highway of value creation you see on this slide. The left column is the scarcity engine, the right is the traditional operating grid. Capital intensity on our side, the entire infrastructure is a cold wallet, a custody contract, and maybe a quarterly audit. That's basis point money. An operating business, by contrast, bleeds capital into factories, R&D, SG&A, and a parade of middle management offsites. One strategy fits on a USB stick, the other requires real estate, payroll, and a prayer to the logistics gods. Time to value, scarcity compounds before lunch, we raise equity at the open, wire the fiat, take custody, and every share owns more Bitcoin by the close. Operating cycles slog through 12 to 36 months of prototyping, regulatory hurdles, and distribution. Bitcoin settles value in hours, a new product line arrives fashionably late, if at all. Reflexivity, when the stock trades above net asset value, every dollar of equity buys more than a dollar of Bitcoin. That jump in BTC per share feeds the narrative widens the premium, and the loop funds itself. Operating margins, on the other hand, attract competitors the moment they look juicy. Profit invites predation, and the edge disappears. The ceiling, Bitcoin's supply is capped at 21 million. While global adoption is still in Chapter 1, there is no theoretical upper bound on per-share scarcity. Operating margins, however, are gated by wages, taxes, and the immutable boredom of economic gravity. Scarcity compounds to the sky, margins flatten at Costco. So when everyone asks why we obsess over BTC yield, the answer is simple. Scarcity outpaces every headwind that crushes a conventional P&L. With that foundation laid, let's look at the scoreboard and see who's already turning this theory into shareholder math. Direct your eyes to the scoreboard first column strategy ticker MSTR. In 2024, they posted a 74% BTC yield. Translation, every share inherited almost 3/4 more Satoshis in a single year. No new products, no new warehouses, just precision capital alchemy. The second column, Apple, the unquestioned monarch of operational excellence, turned in a 34% return on invested capital. Impressive until you notice it's less than half of the scarcity compounding strategy delivered without shipping a single iPhone. Third column, Metaplanet, with a massive BTC yield. That red bar is your cautionary tale. The visual takeaway is brutal and obvious. A well-run Bitcoin treasury can double per-share scarcity in the time a world-class manufacturer is eking out single-digit basis point margin gains. And if you manage the capital structure poorly, the metric exposes you in neon. Next slide, here's the perpetual motion machine in 4 strokes. Watch the arrows. Now, feel free to skip this part if you understand the flywheel, but I just got back from Bitcoin 2025, and after talking with industry leaders and thought leaders in this space, we all agreed education is the #1 priority. Step 1, let's say your stock trades at a 1.8 times its Bitcoin net asset value. The market is already paying a 40% surcharge for the narrative. Step 2 is arbitrage. We issue $100 million of fresh equity into that premium and immediately convert the proceeds into Bitcoin. Because of the 1.8x multiple, shareholders net $180 million worth of Bitcoin for only $100 million of dilution. The premium literally buys the extra $80 million. Step 3 is accretion. The treasury stack spikes, BTC per share climbs. The headline writes itself. Company adds 80% more Bitcoin than dilution cost. Financial press salivates, Twitter loses its mind, and analysts chase their models. Step 4 is reflexivity. The louder the headline, the stronger the narrative. The stronger the narrative, the higher the multiple. Premium expands beyond 1.8x, and the wheel is back at the top, ready for another spin. That's the flywheel. Market premium funds Bitcoin. Bitcoin inflates scarcity per share. Scarcity inflates the premium, and the loop repeats until you choose to hit the brake or the planet runs out of sellers. Slide 7 here is where we turn water into wine, only the water is convertible debt and the wine is permanent Bitcoin. Step 1, you gotta raise the paper. We float a 0 coupon 5-year convertible note for $100 million. Conversion strike set 30% above the spot share price. Step 1, we're going to raise the paper. We float a 0 coupon 5-year convertible note for $100 million. Conversion strike set 30% above the spot share price. 0 interest means the entire coupon stack we'd normally bleed is immediately redeployed into Bitcoin, not wasted servicing debt. Step 2, we're going to swap fiat for scarcity. Within 24 hours, the treasury desks wire the full $100 million into a tier 1 custodian. Execution cost is about 10 basis points all in. OTC spread, legal fees, cold storage insurance. 99.9% of the capital crystallizes into hard-capped collateral on the balance sheet. Step 3, you're going to watch the reflexivity do the heavy lifting. As BTC per share jumps, the equity premium widens. When the share price eventually drifts past the strike, say it rises 40%, the note holders exercise. The liability is discharged in stock, not cash. Our debt literally evaporates. Step 4, you gotta account for the magic. Post-conversion, our share count is up a few percent, but the entire Bitcoin stack remains. The balance sheet has just delevered in fiat terms while levering in scarcity terms. GAAP books it as a non-cash extinguishment gain. The market books it as free Bitcoin. The net effect, shareholders traded a temporary claim with no coupon for a permanent infusion of Satoshis. Interest expense, 0. Principal repayment, stock that was already premium priced. Capital efficiency, off the charts. That is balance sheet alchemy, self-amortizing liabilities that retire themselves while the assets they financed never leaves the vault. Risk dashboards are not the sexy part of the flywheel, but skipping them is how CFOs end up on CNBC explaining a dumpster fire. 3 red flags, 3 antidotes, let's go. First risk is Bitcoin volatility. Mark-to-market accounting can turn a stellar quarter into a headline loss if BTC sneezes 10% on month-end close. Share price whips, auditors hyperventilate. The mitigation, we run a light covered call strategy on 5 to 10% of the stack, harvest premium that cushion downturns, and disclose BTC per share growth alongside gap so investors see through the noise. In other words, we sell a little gamma so the CFO sleeps at night while the Satoshis keep compounding. The second risk is dilution abuse. If you issue stock faster than you stack coins and BTC flips negative, shareholders feel robbed and Twitter mobs sharpen their pitchforks. The mitigation, hardwire a board-approved stack to dilution ratio. 2 Satoshis added for every 1% share creep, or issuance stops. If the ratio is breached, auto-trigger a buyback funded by operating cash or covered call income. Management comp is tied to BTC yield, not adjusted earnings, so incentives stay pointed at scarcity. The third risk is premium compression. If the MNAV multiple collapses to 1.0 or worse, equity arbitrage dies and the flywheel stops. The mitigation is that you can pivot to low coupon secured debt or structured convertibles until the program rebuilds. And you can simultaneously repurchase shares below NAV to turbocharge Bitcoin per share. Communicate relentlessly. The narrative is oxygen, no blackout periods from IR ever. So yes, the engine can throw a rod, but each failure mode comes with a factory-tested fix. Manage the volatility, police the dilution, and defends the premium. And the flywheel keeps minting satoshis long after cheaper margin models have hit their economic ceiling. Slide 9 is where we separate raw muscle from real efficiency. This is a metric I invented, the TBY, torque-adjusted BTC yield. Definition, plain English first. BTC yield, remember, tells us how many extra satoshis each share picked up. TBY asks the follow-up. How much market premium did we have to burn to get there? In other words, it's the horsepower to weight ratio of scarcity compounding. The formal equation is the BTC per share growth divided by the MNAV multiple. Example 1, BTC per share climbs 25%. The equity trades at a 1.8x MNAV, an 80% premium. TBY clocks in at 0.14, 25% divided by 1.8. Example 2, leave the yield at 0.25%, but let sentiment inflate the multiple to 3x MNAV, a 200% premium. TBY shrinks to 0.08%, same muscle, extra body fat, efficiency almost cut in half. Here's how to grade it. A TBY of over 1 is the Olympic podium. The company stacks satoshis faster than the market priced them. A 0.7 to a 1.0 is an elite CrossFit athlete, strong and lean. A 0.3 to a 0.7 is middle of the pack, doing reps but carrying water weight. And a 0.3 or 0.4 and under is a treadmill hamster, lots of sweat but little motion. TBY turns raw stacking into a true efficiency metric. It keeps management honest, and it tells investors whether they're buying muscle or just paying for the hype. The beauty is that TBY doesn't care how you got the sats, straight equity, zero coupon converts, vendor financing paid in dog treats, only whether every turn of premium translated into durable scarcity. Cheap leverage that actually converts Bitcoin vaults TBY, vaporware equity Dexit. Why it matters? Because investors love shiny multiples until they realize the premium is gobbling their future satoshis. TBY exposes that arithmetic in a single digit. It tells you whether the management has been alchemizing premium into permanent Bitcoin or just spraying dilution confetti and praying the narrative holds. The bottom line is that a high BTC yield is impressive, but a high TBY is a surgical strike, scarcity accretion with almost no narrative drag coefficient. That's the engine we want purring under the hood. Slide 10 is a three-dimensional chessboard, price, dilution, and time compressed into one chart. Read it from left to right and you'll see exactly how scarcity detonates through 2027. The key observation here is that across all these scenarios, 3 prices, 3 dilution speeds, per share scarcity is never negative. Dilution under a flat Bitcoin price still compounds ownership by 30%. That is the asymmetry you buy when you trade margin expansion for hard capped accumulation. If your board can stomach 3 to 5% annual share creep and you believe Bitcoin has a pulse, the math almost refuses to lose. And if price outruns even your wildest assumptions, the scarcity flywheel outperforms every corporate turnaround story on the planet. The bottom line, dilution is a controllable knob. Bitcoin price is an asymmetric tailwind, and the payoff surface looks like Mount Fuji. Manage the knob, respect the tailwind, and shareholder time value compounds on autopilot. Slide 11 distills the entire treasury doctrine into 4 marching orders for any CFO who wants to graduate from margin optimizer to scarcity engineer. First, secure the premium. Do not tap equity unless the stock trades at 1.5 times or more above its Bitcoin net asset value. Below that threshold, the arbitrage is anemic. Above it, every dollar of dilution buys at least $1.50 of Bitcoin. Think of the multiple as cheap rocket fuel. Fill the tank only when the price says 99 cents. Second, blend your instruments. Couple zero coupon converts with out-of-the-money warrants. Converts give you fiat today, zero cash coupon tomorrow, and an automatic debt for equity swap when the share price does its job. Warrants sweeten the terms for investors and cap your interest burden at exactly zero. The mix turns balance sheet liabilities into deferred equity while the BTC stack keeps every Satoshi it ever meets. Third, police the stack to dilution ratio. Hard rule, add 2 Satoshis for every 1% increase in fully diluted share count. Drop below that 2-to-1 threshold and the treasury window slams shut until you claw it back. This single metric aligns boards, bond desks, and Reddit commenters in glorious mathematical harmony. Fourth, own the narrative with radical transparency. Report BTC yield and TBY in every quarterly deck. Tweet them during the call. Tattoo them on the first page of the 10Q if lawyers let you. When investors track the way they used to track EPS, your cost of capital plunges and the flywheel spins faster. Silence is expensive, disclosure is cheap torque. Execute these 4 directives and you transform dilution from a dirty word into a Satoshi minting machine. Fail and you become the cautionary tale. Do not become Sears or Blockbuster. The choice, like the capital structure, is entirely yours. Let's end with the only decision that matters. Your corporation can keep chasing basis point margin in a crowded arena of wage inflation, regulatory landmines, and competitors who will happily undercut you into oblivion. Or you can pivot today into an engine that compounds per share scarcity faster than any operating tweak known to managerial science. Here's the play. Vote tomorrow to adopt BTC yield and TBY as headline KPIs. Put them on equal footing with EPS and cash flow. What gets measured gets worshipped. Authorize the Treasury desk to raise capital only when the equity trades at a minimum 1.5x the NAV premium. Anything below that is financial charity. Anything above is minting Bitcoin at a discount. Mandate a 2-to-1 stack to dilution ratio. 2 new sats for every 1% share creep or the issuance window slams shut. Announce the plan publicly, loudly, and with the giddy confidence of a team that just discovered a legal money printer. Scarcity loves sunlight. If you execute, every share you own today will command more Bitcoin tomorrow. No factory, no headcount expansion, no 3 a.m. supply chain fire drill. That is time value alchemy in its purest form. Scarcity compounds, margins compress. Choose the side of physics.